I call the honourable member Dr Russell Norman.
Thank you, Mr Speaker. I rise on behalf of the Green Party to speak to the Non-Bank Deposit Takers Bill, and actually to echo many of the sentiments expressed by Clayton Cosgrove, who I thought made some really good points. The thing about that people probably don't realise in this pretty obscurely named bill, non-bank deposit takers, is that essentially it covers three entities: finance companies, credit unions and building societies. Now, the people will be very familiar with the finance companies. So the finance companies are, of course, the companies that collapsed and cost taxpayers many hundreds of millions of dollars as they had to bail them out. And I'll get back to that, particularly South Canterbury Finance, where the bailout was mismanaged by the current government. But finance companies are a very different kettle of fish to the credit unions and the building societies, but they're all being regulated together under this one piece of law, the Non-Bank Deposit Takers Bill, or Act as it will become. And that is a problem. And it's a problem because credit unions and building societies have a very different risk profile to finance companies. And in the Reserve Bank's report that was delivered very recently about the review of the non-bank deposit-taking sector, there was some discussion of those differences. And I think that this is a real missed opportunity to actually make sure that the regulation of the credit unions and the building societies accurately reflects the risk and performance of those two kinds of institutions, which is fundamentally different to the finance companies. Now, if you cast your mind back, if one casts one's mind back through the earlier part of this century and the emergence of the finance companies and the huge risks that the finance companies presented. During all of that period, all of our regulatory agencies completely failed. And so you would have to say the Reserve Bank, Treasury, the trustee structure that was set up meant to provide oversight fundamentally and completely failed the people of New Zealand in providing adequate prudential supervision of the finance companies. And the proof of that is the fact that the finance companies overwhelmingly, almost all of them went belly up, they went bankrupt, and at the end of the day it was the depositors in those companies and the taxpayer who ended up having to pay the cost of the fact that the finance companies went bankrupt. Mr Speaker, thank you. And so it seems to me that we need to differentiate between those institutions, the finance companies and their regulation, and the credit unions and building societies who didn't go belly up. But it became one of the mantras from the 1980s and 90s of the neoliberal model that one has light-handed regulation of things like finance companies. And unfortunately, the Clark-Cullen government was completely captive to the neoliberal ideology as it applied to the regulation of the finance sector. And it applied the same kind of laissez-faire regulation of the finance sector that has been the ideology from New Zealand since the early 1980s. And that is why we ended up as taxpayers and depositors losing so much money, because of the laissez-faire regulation that the Clark-Cullen government continued through the early part of this century, which meant that the taxpayer ended up having to pay the bill. Now, this government, paradoxically a Conservative government, has come in at a time after the global financial crisis and has had to institute regulation of these sectors. But it is very much after, this is the closing the gate after the horse has bolted. Most of the finance companies have already gone, and so most of the institutions that are now being regulated by this bill, which is a response to the failure of the finance companies, are not finance companies. And this is the paradox of the bill that we have before us. This bill is a response to the failure of the finance companies, but this bill actually overwhelmingly regulates credit unions and building societies. So that is the paradoxical situation we find. And so the incoming Conservative government has had a complete overreaction and a poor response to the situation we're in. We should actually have the regulation of the credit unions and the building societies done differently to finance companies, because they do not have the same level of risk associated with them. And the proof of that is the fact that during the global financial crisis, the finance companies went belly up, but the credit unions and the building societies didn't. And so instead of saying we will have a differentiated regime, we've just lumped them all in together into non-bank deposit takers. Now, there's no question that we needed to improve the regulation of the finance companies in particular. And so that's why we're voting for this piece of legislation. It is the right thing to do, even if it is after the horse has bolted. Hopefully it will prevent a similar thing happening again. And hopefully what it means is that there's a sea change in a kind of philosophy of regulation in New Zealand, and a recognition that the complete and absolute failure of the neoliberal model of laissez-faire regulation has been recognised. I doubt very much that is completely recognised by Treasury and the Reserve Bank, particularly Treasury, but certainly to some degree it has been, and that's a good thing. But by lumping the credit unions and the building societies in under exactly the same kind of regulatory regime, I think is a bit of a mistake, and we need to differentiate. So in the implementation of this law, given that it's going to go ahead, it is very important that the Reserve Bank differentiates between the credit unions and the building societies on one side and the finance companies such as they remain on the other. Now, unfortunately, there's not a great recognition that this will happen. We had the Reserve Bank in front of Finance and Expenditure Committee a few days ago where I raised these issues, and there was some acknowledgement of the issues, but I don't think a great acknowledgement. There was also, I think, the issue of trustees, which I think we really have to address. Now, for people who don't know, these non-bank deposit takers, finance companies, credit unions, building societies, they have these trustees that are meant to provide supervision. Now, what we know about the trustee model is that it is a complete failure. A total and absolute failure. And the proof of the failure of the trustee model is that deposit takers lost millions and millions and millions of dollars, the depositors rather lost millions of dollars, and the taxpayer lost millions of dollars because they had to bail the thing out. So given that the trustee model has proven to be a complete failure, why are we continuing with it as if it works when we know that it doesn't? It's been proven that it does not work. The trustee model does not work in terms of providing prudential supervision of these companies, and the proof of that is what actually happened. But we carry on and pretend that the trustee model works. It does not work. And so why don't we actually introduce regulatory regimes that have a better chance of working? For example, in the review of non-bank deposit takers, there was talk about treating the credit unions and building societies more like banks and regulating just them directly more like banks because a lot of their behaviour is bank-like. Why wouldn't we regulate them more directly, more like banks? And in the process, get rid of the trustees who are useless because they do not protect these companies from acting poorly, as we saw with the finance companies, and by getting rid of the trustees at the same time we also reduce the red tape and the regulatory burden on the credit unions. A regulatory burden that the banks, their competitors, do not face. So if you're a credit union, you've got to have this elaborate structure above you of trustees and so forth that all has to be supported. If you're a bank, you don't. And so yet we lumber the credit unions with this elaborate kind of regulatory burden that they totally do not need. Why don't we regulate them much like we regulate banks and let the credit unions compete with the banks on a fair, even playing field, reduce the regulatory burden on the credit unions so they can compete for deposits with the banks? I think that in the implementation of this regime, it would be great to see the Reserve Bank recognise the reality of the difference between the finance companies and the credit unions and the building societies. And that is one of the fundamental problems of this legislation. We're supporting it because I think we need it, but I think it is important as we go forward that we, in the implementation of the law, we recognise the difference, but I think in the future we're going to have to change the legislative framework around credit unions in particular to recognise the actual risks associated with credit unions. And I also think we need to acknowledge that the trustee model completely failed. It didn't work as a way of actually preventing failure, widespread failure of the finance companies. It was a failed model. But nonetheless, we'll be supporting legislation, but we look forward to future improvements of the regulatory framework in this sector. Thank you, Mr. Speaker.
I call the honourable member Andrew